We talk about financial models, we're talking about raising capital. We're talking about projections into the future of something that will be. But really, I think financial models have a place for talking about exit planning. So how does a business owner start to consider forecasting for an existing business, and why is that so important?
So we always take a look at what have they done historically, how they can improve. We analyze all aspects of the business, like what's their portfolio like, what's the most profitable, what they should continue, what they should abandon, maybe some other services or products they could introduce. Like what are the ways to optimize the business? Because that's the first step towards planning an optimal exit, right? You want to extract as much as possible EBITDA or revenue you can over a certain period in the future. It's usually the centerpiece of any decision when it comes to finding a partner, exiting, selling some shares, or whatever you want to do.
Yeah, it is the centerpiece because it's all about money.
Yeah.
I mean, yes, it's about many other things qualitatively, but this discussion is about the dollars and the cents, the numbers.
One way I look at it is a tool, an internal tool, to define that path to an exit. Let's say that a company, a founder has a 100 million exit goal, and with speaking with an advisor or doing a bit of research, you understand that in your industry in that time, you probably need a 10 million EBITDA or operating profit to get a $100 million exit, right? So you instantly see where you need to get that type of money. Then you can easily compare it to where you are now in terms of EBITDA, right? And you observe instantly the gap based on your growth rate. You can estimate how many months and years it is going to take to get there. And this is maybe the more basic level of exit planning. Then you get a step deeper. You start looking at your revenue streams, your product and service lines. And one thing you can do, which Predrag does very well, is calculating the profitability per product line or per service line. And it's easy to see that you're making a bit more money, a bit more margin on certain services and a bit less on others. Allocating budget, marketing, resources to one versus another, and budget is always limited, right? Allocating budget to one or another is going to either accelerate or slow your exit path, or it's going to create a company that is going to have more or less EBITDA in 24 months from now. So that is a very simple example of a decisional tool to dictate what strategic decisions you're going to make.
Very often, we recently had a non-alcoholic beverage client, and there are some products which are more profitable, but you lose more cash flows because of a higher inventory. You need to have more inventory. So although it's more profitable, they just simply don't have enough cash flow to grow fast using that product line. So they needed to refocus on some other product line. Although it's slightly less profitable, you can grow faster. So there are different ways and different things to consider, when optimizing the growth and cash flows, which ultimately lead to higher EBITDA.
It's not uncommon to find business owners that don't know the level of detail that they probably should. And I think this is because they're so focused on revenue, right? They're just sales. A lot of CEOs are sales driven, strategic partnerships, just more and more and more. Sell, just push it out the door. It's not until they take a beat or they have to take a moment to go through the model and really understand every nuance of the business. What do you often see? What are the things that you see business owners overlook commonly?
The first one that comes to mind is cash flow analysis. It's a bit more technical because there's some monetary and some non-monetary items that are, a little bit harder to grasp. But that's an analysis, an indicator that preserves a company entrepreneur from staying cash positive, not running out of money, which causes looking for debt, get financing, slowing down, shutting down, right? So that's something that we typically calculate because it almost ever exists.
Yeah, and when doing such deep analysis, many clients have a lot of aha moments while we discuss the model, while we fine-tune it. We had models with 30 plus versions, iterations, because we always figure out something else that can be added that's not realistic, and then clients have, it's a lot of education for the clients as well. Like they learn a lot of things as we work with them.
I'll give you an example of this. We did a different model where the lifetime value of a customer, which can be calculated, and we could talk about it another time, was never higher than the customer acquisition cost. And you saw that very clearly in the model, right? It's also a formula and an estimate, and when that happens constantly at scale, that business will never be profitable. Doing the financial model, maybe it doesn't relate so much to the original question about the exit, but it tells you, I gotta stop and do something differently, because otherwise I'm building a business that will get me in trouble, and certainly a business that I'll never sell.
And there's a scenario where you see a business that has been profitable, and they've been in business for a very long time, and it's not until they hire us to go in there and start tearing apart the numbers, and you're like, why are you still doing this thing?
Yeah.
And they're like, well, we've just been doing that thing for 20 years. And you're like, yeah, but if you stop that, you could then redirect those efforts. Do you see that?
Yeah, and I don't want to take I wouldn't want to imply, okay, we come in and we see things that other people don't see. I think it's about perspective, right? An entrepreneur is often in a bubble, especially small companies, small businesses. They're in a little bubble where nobody really questions them. They have to rely on themselves. But having another set of eyes that says, oh, can you explain to me why you're doing this? Or could you do this differently? Oh, we've seen another client doing it this way. Have you tried? That puts them in in the position of having to answer somebody else and see things, right? The answer is probably already there. They just, we're not seeing it yet.
Like small business owners are usually super busy, and they just don't have the time to rethink what they're doing. Like they just keep rolling and having more and more calls, trying to sell more and more and more.
Yeah,
and
wearing many hats.
Yeah, there's not like time to stop and say, okay, what are we doing? How do we improve? And that's where we often come in. It should be easy to see some of the things. It's like we're not geniuses, right?
Right.
But like it should be easy, but like you just don't have the time to do it. And then a fresh perspective is usually very useful, even for like simple changes that can be big. Like it doesn't need to be very complex. You just need to to find time to analyze some things, and like
it's like simplicity is the ultimate sophistication, right? Sometimes you could just look at the numbers, and you're right. I think the biggest gains sometimes I think come from the simplest changes, and we can find those changes just jumping into the percentages and the margins and seeing what's actually happening.
Yeah, charts. Sometimes a very simple chart gives you the visual on a simple pie chart or bar chart, gives you the visual on something that might be off or that looks disproportionate from where you think it is.
Well, that goes back to the theme of seeing the future through the spreadsheet, through the lens of the spreadsheet. When we look at it with a diverse perspective, again, we don't have to be geniuses here. We just see things differently, and we see things from multiple industries. So is there a correlation sometimes? Do you make connections where you see something working really well in one industry and then you apply it to another?
Well, sometimes yes, but then also each industry has very different KPIs. Like we have now a long-term client working for us with like 5 years in med spa business. Like their KPI is gross margin per hour. That's all they care about, because service providers have very high salaries, and like you can only book them for 8 hours per day. So you want to book them with services that will yield the highest gross margin per hour. While some other industries, it's like, profit per product, and you just want to have volume. So it's very different, and sometimes you can apply some things from one industry to the other one, but then it's also about experience and knowing the KPIs for each industry.
And the numbers need to hold weight. See, that's the other thing. If there's, especially in an exit environment where we start shopping the deal and you start going through due diligence and you get someone on the other side of the table looking at the numbers, asking those big questions, because they're going to ask.
Yeah. So this is a very important point, and there is a general understanding that once you get into that acquisition, exit conversation, a lot of the attention is on the past financials, and it is, right? Because typically the last 3 years of income statement balance sheet is the first request an owner is going to get. Okay, fine. They need to be there, and the cleaner they are, if audited, better. What about projections, right? Projections are often by advisors, buyers, they're discounted, they are discarded in a way because projections usually go like this, right? They always go like this. I've never seen projections that go like this, right? But projections tell the story of what is the growth plan of the business. And any buyer, whether the management and the owner is staying on or whether it's fully exiting, they're going to want to know, how is the business going to grow in the next 3 years, maybe even 2 years, right? And I think having good financial projections that are based on good data, good rationale, clear inputs and drivers, they're going to be able to support that growth story. And I would argue, a business that doesn't have projections getting to an exit, if I'm on the other side, I'm like, okay, there's no plan for continuity. People aren't even thinking about growth because maybe there is not a growth plan. And I would be a big red flag for me.
Yeah, definitely. And you mentioned it, but like having clear assumptions supporting the projections is essential because it's easy to make projections, right? You show a graph like with some growth rates, but you want to really show what assumptions you used, what strategic choices you made to support those projections, and how did you connect all of the different dots, what's leading to your numbers, and then you want to justify your projections. Like it's important that it's simple but clear.
Yeah.
Between simplicity and details in a way. Like
striking a good balance. Yeah. I want to make a connected point of this. The models that we build and that I believe a company should build are dynamic, right? They're based on easily changeable inputs, right? Now that allows even an external audience like a buyer or an investment banker to run scenarios, right? Because the way the owner sees the next 2-3 years might be different than what a private equity fund or strategic buyer sees the future, right? So changing some of the levers and saying, you know what, we're not gonna allocate that much marketing budget to customer acquisition because it's not in our company philosophy to do so. We believe more in inbound or referrals, whatever, right? So the ability to drop that budget and say, I'm actually gonna invest in research and development, or I'm going to stop all, sales campaigns that we did in the past. How does the how do the numbers change? And we've had a number of instances where investors and buyers have used the models that were created to see, is this business actually going to, go the way that we think it's going to go? Is it worth to us what we're about to invest, to buy or take share in this business? And everybody can also disagree on a financial model as long as it is a conversation tool. It's a tool that continues the conversation and negotiation towards an exit.
And models are like living and breathing things. We have many clients, for example, insurance company, that come to us like every 3 months to help them update the models. Yeah. And also they have requests from investors, and then they tell us, oh, can you edit this version of the model for this investor with this request? So there are multiple versions of the models for different investors based on their request.
Yeah, so they can benchmark and hold the team accountable, set KPIs internally. Yeah.
And every month, every week, you learn something new about your business, different metric, different data point. The assumption need to change, and that's why we continue to revisit them. Some of our clients continue to use the ones that we build, for example, on Google Sheets or in a live shared model, and they continue to use it as a benchmarking tool.
Financial model is a bit of an art and a science. I think we talked a little bit about the science of getting the inputs right and looking at the cash flow, the balance sheet, income statement. But where does the art come in?
I like saying that anybody can paint a picture, but like almost nobody can paint a masterpiece, right? That's where the art comes in. Like you can learn accounting rules, but like if you stick to them like strictly, it won't work really for the models. Like for the models for projecting the future is different than following accounting rules for what happened in the past. You have to be creative. You have to think about what story needs to be told. Like what do I want to say with this model? What is its purpose, right? Is it for internal planning? Is it for an exit? Is it for a partnership? Is it for M&A? Is it for changing the direction, the portfolio. You really want to think about the purpose of the model, but also the uniqueness of the business. As we mentioned before, like different industries, different company sizes, different markets, like you need to take all of that into account, and you need to play with the model a lot. That again comes to the point that we never have only 3 versions of the model. It's always like 5, 10, sometimes more, because you're fine-tuning things, you're coming up with different ways to create something really good for the client.
I always thought that models are more art than science, to be honest. For me, it's a framework for expressing concepts. And I think, going back to the point of setting up your goal and deriving, reverse engineering what you need to do, I think the art comes into your projections are not getting you to where you want, right? You can actually get there with a model, right? You can reach those goals or that valuation, but you understand what are the levers and the drivers that you force or that they need to increase or change in order to get there. And are you okay with those new assumptions, right? What do you need to do to get that production cost lowered by 14%, which gets you to the profitability? Or if you need to acquire 100 more clients that you expected this year, okay, what do you need to do to get those 100 extra clients that get you to that exit valuation? And so it's a way to think more creatively about possible solutions, right? Instead of being limited by the original numbers you get.
So what would your final call to action be to any business owner that wants to see more with their business through the lens of a financial model?
No matter what your preparation with the model, open an Excel spreadsheet and type in there your fundamentals, your key levers. It doesn't need to be sophisticated. It could be one tab, no format. Put your key economics, right? The unit economics, right? And understand how do you get from sale to profit, right? How do you get, what is the gross margin? Like simple stuff, it'll make you think and you build on it, right? Then you need help, give us a call, hire some help, right? But you can start simple and get to simple conclusion that will get incrementally more interesting.
I would say also be open to change, because many times we have clients who have, like in advance, they want this outcome in this way, but sometimes the model simply doesn't work. Like through our process, we see that like what they imagined is not working. And then there's this balancing of you don't want to make the client angry, but you also want to tell them the truth. So you're giving them piece by piece. You're not telling them in advance like this doesn't work at all. You're like, but you see, if you increase the marketing expenses, like the customer acquisition cost will be higher than gross margin per product or customer lifetime value. And like little by little, you make them see that the model doesn't work, and then you try to come up with different solutions.
And for the record, I've never seen Predrag making a client angry. Okay, so it's got to be the other.
Well, being open to change, I love that. That's a great segment closer here. So Predrag, Antonio, thank you so much.
Thank you for having us.